Today we're talking the number one thing I see property investors miss all the time that's costing them thousands. Today I want to talk about the most common thing I see investors miss, and this is really applicable this time of the year as we're coming up to tax time, and that is depreciation schedules. Depreciation schedules can make property investors tens of thousands of dollars more each year when it comes to working out the final numbers for their properties. So what is a depreciation schedule? Essentially, a depreciation schedule is an estimate of the value of your property and the building of your property and how it will deteriorate over time. So a good example of this is to think about a pencil. As you use that pencil, it becomes less and less useful until eventually it's got no life left in it. This is what a quantity surveyor goes out and looks at a property and will essentially allocate the life of your property a value. So even though you bought the home for say $400,000, you may actually be able to claim $200,000 of that off over a set period of time. So how does this actually benefit for you? So a quantitative surveyor will go out and estimate the value of your property, the building of your property, and will assign it value. So you may end up with a $10,000 per year depreciation schedule. If you're able to write $10,000 off against your property, you'll get this back in tax. So say you earn the average income in Australia somewhere around that $70,000 mark, your tax bracket you're in will be 32.5 cents for each dollar. So if you've got $10,000 you can write off thanks to a depreciation schedule, you're essentially able to claim $3,250 back in tax, which becomes quite attractive. Over 10 years, that's $30,000 that you could be saving thanks to a depreciation schedule. So how do you know if a property qualifies? The easiest way is to reach out to one of the companies and speak to them. Most of the big depreciation, quantitative surveyor companies, BMT Tax Depreciation, Washington Brown, there's quite a number. A simple Google search will bring up a number of the different companies. They all essentially offer a guarantee that, most of them anyway, most of them offer a guarantee that if their level of depreciation isn't twice of that of what their charge is, then they don't charge for the report. So for instance, if the report's $500, if they can't get you $1,000 in the first financial year of depreciation, they won't charge you for the report. So speaking to a depreciation company will really give you a good idea of what sort of depreciation, what sort of amounts you could expect to get from a certain property. But as a guide, there's three main triggers to if a property is worth getting a depreciation schedule on. The first one is if the property is brand new. Now, a brand new property is going to give you considerable depreciation compared to an older property. You'll be able to claim things like the washing machine, the carpet, those sort of electronics, that sort of thing, air conditioners. You'll be able to claim that, which you can't do if the property isn't brand new. The second thing to look at to know if your property is worth getting a depreciation schedule on is if the property was built post 1987. So anything pre-1987, you can't claim depreciation against the building. Where anything built from 88 onwards, you can actually depreciate the building. So that's where it becomes quite a large sum that you can depreciate over time. The third and final factor that worth considering when you're looking at if a depreciation schedule is needed is if there's been more than $40,000 spent on renovations. Essentially, most depreciation schedules will write the asset off over a 40-year window. So that way you'll have $1,000 reductions per year, or give or take that sort of amount if you've had more than $40,000 worth of renovations done to a property. Like I say, the easiest way though is to ring up one of the companies and have a chat to them. Most of them anyway, do offer a guarantee that the depreciation will be twice that of what they actually charge. So if they're saying it's worth doing the report, it definitely is worth doing the report. So here's a recent example of a depreciation schedule that we ordered for a property that we own. I'll run through it and give you a bit more of an example and give you a real life sort of picture of what we're claiming. So this depreciation was done up by Washington Brown. It's not a recommendation for them, but that's who we chose to go with. There's a number of different companies that do offer the services. So a quick Google search will bring up the number of different companies that offer it in Australia. We went with Washington Brown for this depreciation schedule. So this property was built in 2006. It is a sort of a resort style complex, so it does have resort style pools, a couple of barbecue areas. All of this we own a portion of. So I think there's 70 units in the complex. So the pool, we own 1/70th of the pool and are able to claim depreciation against that portion of ownership of the common grounds of that unit complex. So we bought the unit for 175,000. Of that, Washington Brown has allocated 140,000 that we can depreciate off the unit of depreciate against tax over time. So that is 140,000 that we're able over a 40-year period able to claim back against tax. And as well, it shouldn't really affect the value of the property as the building does get older. We obviously will need to do renovations to the property, but those renovations will also become a tax deduction. So you're sort of double winning. The value of the land hopefully going to increase over time, so that will protect the purchase price of the property, while you're also getting the tax advantage of being able to write off that 140,000 against your income tax over time. So if you're in that sort of medium income bracket, paying around 32.5 cents, 32% tax, you're going to get about 40,000 back over the life of that property if you held onto it for a number of years. So to give you a bit more of an example of what's included in a depreciation schedule, essentially they'll give you a full breakdown of the fittings and fixtures and the building. So everything from the built-in robes down to even like the kitchen sink and the tapware. So you'll get a full breakdown of every single thing, and how much you can claim against that item in the property. So for this property, the first full financial year we will own the property, we'll be able to claim 3,500 in deductions. Now, essentially, the taxation office sees this as a cost against you, without you actually having to pull money out of your pocket each year and pay for it. So, with a $3,500 reduction each year, if we're paying around that 32% tax, that's about $1,100 each year that we'll get back from the taxman as a tax credit per se. So you can really see, over 10 years, that's 35,000 in deductions we can claim against this property. This report cost us, I think, around $500. Most of the depreciation schedules are around $500 to $1,000. So you can really see how quickly you get your money back from paying for one of these reports. You're really getting your money back within the first year for most properties. As I say, if you are unsure if your property is going to be eligible or worthwhile doing a depreciation schedule on, I'd really recommend reaching out to one of the quantity surveying companies. They're experts in this field and they'll be able to give you a really good guide as to if it's worthwhile doing it on your property. Otherwise, speak to your accountant as well. So there you have it. Leading up to tax time, it is well worth having a chat to your accountant, having a chat to a depreciation specialist, and seeing if your property does qualify to do a depreciation schedule, as it could save you and make you thousands in the long run.